Have you ever wondered how people grow their wealth through the stock market while others feel lost and overwhelmed? Many beginners believe stock investing is only for financial experts or wealthy individuals, but that is far from the truth. With the right blueprint, anyone can start building wealth through stocks, even if you are completely new. In this video, I am going to break down investing in stocks for beginners step by step. By the end, you will have a clear path to get started with confidence, avoid common mistakes, and begin your journey toward financial freedom. Let us begin with the basics: how to get started with stock investing. Stock investing simply means buying small pieces of a company called shares. When you own shares, you are part owner of that company. If the company grows and earns profits, the value of your shares increases. You can also earn money through dividends, which are payments some companies make to shareholders. Think of it this way: if you buy a share of your favorite coffee shop and that coffee shop expands and makes more profit, the share you own becomes more valuable. This is the essence of stock investing, putting your money to work so it grows with the business. For beginners, the first step is to open a brokerage account, which is like a digital wallet that allows you to buy and sell stocks. Some popular platforms include Robinhood, Fidelity, Charles Schwab, or international platforms like eToro. Once you open an account, you can deposit money and start exploring. But here is where many beginners go wrong: they jump in without understanding the market. This leads us to unlocking the stock market and learning essential strategies. The stock market can feel intimidating, with numbers moving every second and financial jargon flying around. But in reality, it is simply a marketplace where people buy and sell ownership in companies. To succeed, you need a strategy, not luck. One powerful strategy is to think long-term. Do not expect to get rich overnight. Legendary investor Warren Buffett often says the stock market is designed to transfer money from the impatient to the patient. Another important strategy is diversification, which means spreading your money across different companies and sectors instead of putting everything in one stock. For example, if you invest only in a technology company and it performs poorly, your whole investment suffers. But if you also own shares in healthcare, energy, and retail companies, your portfolio is more balanced and resilient. Mini summary. To get started, you need to understand what stocks are, open a brokerage account, and learn essential strategies like long-term thinking and diversification. These steps are the foundation of your investing journey. Now let us move into something practical: 5 simple steps to kickstart your stock investment journey today. Step number 1, define your goals. Ask yourself why you are investing. Do you want to save for retirement, buy a house, or simply grow your wealth? Clear goals will guide your decisions. Step number 2, set a budget. Never invest money you cannot afford to lose. A good rule is to start small, even with as little as $50 or $100, and increase as you get comfortable. Step number 3, choose an investment style. You can be a hands-on investor who researches and picks individual stocks, or a hands-off investor who uses index funds or exchange-traded funds, which automatically give you exposure to many companies. Step number 4, do your research. Before buying any stock, understand what the company does, how it makes money, and whether it has potential for growth. Step number 5, take action and start investing. The most important thing is to begin, because waiting for the perfect moment often means never starting at all. Here is a short story to illustrate this. Kevin, a beginner, waited years hoping to time the market perfectly. He wanted to buy when prices were at their lowest, but he kept waiting and missed out on growth. Meanwhile, his friend Maria started small, bought consistently every month, and built a portfolio that grew steadily over time. The lesson is simple: starting is more important than timing. Now let us dive into Investing in Stocks 101, a comprehensive guide for beginners. When you hear about the stock market, you will often encounter 2 main approaches: active investing and passive investing. Active investing means you are selecting individual companies and trying to beat the market. Passive investing means you invest in funds that track the overall market, like the S&P 500 index. Studies have shown that most people, even professionals, struggle to beat the market consistently. That is why many beginners prefer passive investing, because it allows them to ride the overall growth of the economy without needing deep expertise. Another important concept is dollar cost averaging. This means investing a fixed amount of money at regular intervals, for example, $100 every month. This strategy reduces the risk of buying at a high price because sometimes you buy when prices are high and sometimes when they are low, averaging out over time. Mini summary. Your beginner guide is simple. Decide between active or passive investing and consider dollar cost averaging to build wealth consistently. Mid-video reminder. If you are enjoying this beginner-friendly breakdown of stock investing, make sure to subscribe to Financial Freedom Path. We share videos every week that simplify money and investing so you can take control of your financial journey. Hit that subscribe button now so you never miss out. Now let us move to a key part of our blueprint, mastering stock investments without breaking a sweat. The truth is, investing should not be stressful. If you are losing sleep over your investments, you might be taking on too much risk. Beginners should focus on building habits instead of chasing quick profits. One powerful habit is setting up automatic investments. Many brokerage platforms allow you to schedule monthly deposits directly into your portfolio. This way, investing becomes as routine as paying a bill, and you build wealth passively. Another habit is reviewing your portfolio occasionally, but not obsessively. Checking your stocks every hour will only create anxiety. Instead, review once a month or once a quarter to see if your investments align with your goals. Let us share another example. Emily, a college student, started investing $50 a month into an index fund. She did not worry about market ups and downs. 10 years later, she had built a solid portfolio that gave her confidence and financial security. She never tried to outsmart the market, she just stayed consistent. This story highlights that you do not need to be an expert or rich to succeed in stock investing. You need discipline, patience, and a long-term view. Another critical tip is to avoid emotional decisions. Many beginners panic when the market dips and sell their stocks at a loss, but history shows that markets recover over time. For example, during the 2008 financial crisis, many investors sold everything out of fear. Those who stayed invested, however, saw their portfolios grow significantly in the following decade. The mini summary here is clear. Investing success comes from habits like automatic investing, consistency, and avoiding emotional reactions. Let us now address some common mistakes beginners should avoid. Mistake number 1, investing money you need in the short term. If you need that money in 6 months for rent or a vacation, do not put it in stocks. Mistake number 2, chasing hot tips. Many people hear about a trending stock on social media and rush to buy without research. This is dangerous because hype often fades quickly. Mistake number 3, ignoring fees. Some investment platforms or funds charge high fees that eat into your returns. Always check costs and choose low-fee options. Mistake number 4, not diversifying. Putting all your money in one company or one sector is risky. Spread your investments to reduce risk. Mistake number 5, expecting quick riches. Stock investing is a marathon, not a sprint. The real wealth comes from compounding, which means your returns generate more returns over years. Here is a quick story. Josh invested in a popular tech stock because all his friends were talking about it. The price shot up at first, but then crashed, and he lost half of his money. Meanwhile, his colleague invested steadily in a diversified index fund. Over time, her portfolio grew steadily, and she avoided the stress of dramatic ups and downs. This example shows why avoiding mistakes is just as important as following the right strategies. Let us wrap this up with a clear blueprint for beginners. First, understand what stocks are and how they work. Second, open a brokerage account. Third, set clear goals and a budget. Fourth, choose between active or passive investing. Fifth, consider strategies like dollar cost averaging and diversification. Sixth, build habits of consistency and patience. Seventh, avoid common mistakes like chasing hot tips or panicking during downturns. If you follow this path, you will be far ahead of most beginners and well on your way to building wealth through the stock market. Final mini summary. Stock investing is not about being lucky or predicting the future. It is about having a plan, staying disciplined, and letting time do the heavy lifting. Even small investments can grow into something significant if you start early and stay consistent. Thank you for watching this complete beginner's guide to investing in stocks. I hope you now see that anyone can start, no matter their income or experience level. If you enjoyed this video, please give it a like and share it with someone who wants to learn about investing. And most importantly, subscribe to Financial Freedom Path. In the next video, we will talk about how to automate your finances so you can grow your wealth with less effort and more confidence. You do not want to miss it. So hit subscribe and take your first step toward financial freedom today.